So there was this constant thing of, well, listen, Mr. Banker, slowly but surely realized no one's coming in to check their books to see if they had it. So they would overprint notes, and then the notes would bomb, and everybody would come down and say, give me your gold and silver, and there wouldn't be enough gold and silver. I don't think it throws everything off track yet. It has the potential to throw things off of track. If you go back to I think it was 2015 when the Fed started raising interest rates, and they raised interest rates a couple times, and everything went haywire, and they had to back off. And I think you're in a similar situation right now. The Fed is likely to raise interest rates 2 or 3 times over the course of 2022. They are tapering on their bond buying program, and I think that they would stay that course, but for 2 things. One is COVID. If COVID gets worse, that obviously could cause them to slow their withdrawal of monetary accommodation. And the other thing is the overall economy. And with the ongoing efforts of Democratic politicians in the United States to prove that they really should not be in charge of the government, they just can't get their act together. And the latest debacle with the Build Back Better bill, you've seen a number of major economists at banks and brokerage houses and independent research institutions start to downgrade their growth expectations for the United States for 2022, predicated on the view that stimulus isn't going to be there, and that could create a real headwind for economic recovery to continue. So I think that it's a combination. It's actually 2 punches. One is COVID, and the other one is the idea that we could see a weaker economy. Either of those things could cause the Fed to be more accommodating than they indicated in their statements and actions earlier this month. Portion of the equity market and the investment community that has priced that into their models. But there's a larger portion of dollars invested in equity markets that is valuation model driven. And they may anticipate increases in interest rates, but they will not necessarily lighten up their stock portfolio until the actual event. So when you see a 25 basis point increase in interest rates, then you would have an immediate, stocks have to be that much lower to be competitive with interest rates. But after that, then you have it kick back up because you have other people saying, okay, we already knew this was coming. I know what the concept is, but I say, if you think that stocks are risk on, look at the stock price. Look at the stock market since 2010. That's not a particularly risky thing. It's had much lower volatility for most of the last 11, 12 years than, say, gold and silver. But then the stock market is an index of 500 stocks or 30 stocks, whereas gold and silver are single assets and they're much smaller. So it's not really comparative. I think that what you're going to see is more of the same in 2022, at least in the first half of the year. So the stock market will continue to be driven by A, ample money supply, and B, stock buybacks by corporations and increased dividend yield generation, because I think the economy is still going to be strong. These companies will have free cash flow. They will use some of it for business investment, but a big part of it will be dividends and stock buybacks, which will keep the stock market up. At the same time, we think that gold prices probably are flat to slightly higher, maybe 2% higher on an annual average basis next year. And silver prices might be 2% lower on an annual average basis next year. But we do think that investors will continue to be buying large amounts of gold and relatively large amounts of silver, but not as much as they have in 2020 and 2021. I share that view with severe reservations. You have a lot of people talking about how electric vehicles are going to use 5 times or 8 times as much silver as a conventional ICE engine. In reality, if you talk to the auto industry and you look at the engineering reports, they're probably going to use 1.5 to 2 times as much silver. So I look at automobiles and electronics and the electrification, and I say this is all good for silver, but I think there's a tremendous amount of overly enthusiastic bullishness, and that has 2 effects. First off, the main effect is that, and this is one of the reasons why we see a weaker silver price and lower investment demand for silver next year compared to gold is there are a lot of investors who have listened to a lot of bad information, and they bought silver at $28, $30, and they were expecting $100, and now it's $24, $25, and you're seeing a lot of bearishness and a lot of there's a lot of dissatisfaction that they were sold a bill of goods. And I think one of the things that we're going to see, and I think I've talked to you about electric vehicles going forward, I think one of the things that you're going to see in 2022 is a much closer scrutiny of what electric vehicles and the green energy revolution actually mean, both for the economy and for individual metals, everything from copper and nickel down to silver. If you look at the International Energy Agency's big report this year on the effect on metals, critical minerals and metals of the green energy revolution, silver's not in there. They're not worried about silver, and I think that there's going to be any number of investors. There already are a number of investors who are showing their dissatisfaction for silver relative to gold because they feel they've been sold a bill of goods by over promoters. And I think that that's going to continue to weigh on silver relative to gold in 2022. I mean, I've been stacking silver since the 80s, but I'm a rational stacker, and I don't ever expect to have to use it to buy milk and bread at the corner store. 150 years ago, you had to. If you go back to the expansion of the United States to the West, you didn't have a central bank, you didn't have a central currency. Currency, bills, were issued by regional banks, state banks. And, it's like, so I'm in Ohio, I want to move to Kansas. I take my money out of the bank. I go to Kansas and I say, well, I've got all these bills issued by the first bank of Canton, Ohio. And the banker in Kansas says, where's that? So what you did was you went to the bank and you said, give me Spanish silver coins, pieces of 8. And pieces of 8 were the major currency used in the Western expansion of the United States. If you wanted to buy milk and bread, or as my wife says, we don't know how the pioneers went across the country without a steady flow of coffee. But if you wanted to buy stuff, you converted your money into silver. When all of those people came out of Europe and came to the United States, they didn't bring Lithuanian currency. They went to the Lithuanian bank and they said, I'm moving to America, give me silver. Well, it changed for a variety of reasons. One was the rise of central banks, and all of a sudden you had more stable banking. The reason why we had banking panic after bank panic in the 19th century was because you didn't have a central banking system and you didn't have effective oversight. You had all these state banks. You had no central bank, no national bank. You had state chartered banks. The states didn't have the wherewithal to really monitor them. So there was this constant thing of, well, listen, Mr. Banker, you have to have a certain amount of gold and silver in your safe to back the currencies you're issuing. And then the bankers would slowly but surely realize no one's coming in to check their books to see if they had it. So they would overprint notes, and then the notes would bomb, and everybody would come down and say, give me your gold and silver, and there wouldn't be enough gold and silver.